Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be talking about something I've never talked about on the channel, which is insurance stocks, and if these companies can be a very good hedge against inflation over the coming years. With so many different insurance companies offering different rates and coverage options for each individual consumer's needs, it becomes insane for the consumer to figure out which one is the best. However, despite all of this terrible confusion for the consumer, for the investor, these businesses can be excellent recession-proof stocks to hold in a long-term dividend investing portfolio. For instance, Warren Buffett hasn't just chosen insurance companies to be the backbone of Berkshire Hathaway for no reason at all. In fact, it's known that Berkshire's insurance businesses have actually proven to be their largest growth drivers over history. So with a little bit of insight today, you'll be able to understand how insurance companies make money in a very unique way while benefiting investors big time. In today's video, I'll be highlighting some of the benefits of investing in the insurance industry and if you should consider buying any insurance stocks right now. So don't forget to drop a like on this video to show your love and support. I really do appreciate it, guys. And if you haven't already, definitely consider subscribing down below, as it does really help out my channel and you won't miss any future uploads. So without further ado, let's jump right into insurance stocks. So we first need to understand how insurance companies even make a profit before we can understand why they can be a great hedge against inflation. Now, there are two primary ways that these insurance companies make money that you should be aware of. The first is by charging insurance premiums to the people that they insure. So in essence, by selling insurance policies, the companies try to profit the difference between the premiums that they earn and the claims that they have to pay out. And this type of income would be known as the underwriting profit. However, for most insurance companies, this is not where the majority of the profit is actually generated for the company, and sometimes this segment actually operates at a loss, which would be considered an underwriting loss. But this is where the second and more important money-making strategy comes into play. So method number two is insurance companies are going to invest the cash flow that they earn in terms of the premiums before they're actually paid out as claims. This type of money is known as the float to an insurance company. By investing their float in safe and higher yielding investments than holding cash, such as high quality bonds, they're able to earn a substantial profit before using the money to pay out claims. But other companies might want to take on a little bit more risk and choose to invest in stocks or other riskier asset types to try and earn a little bit more money. But either way you have it, this is how insurance companies generate the majority of their income. Now, there are several different types of insurance companies, such as those that focus on property and casualty, life, health, specialty, and reinsurance, but the concepts for how they make money are the same throughout. So we know that banks generally do very well during times of inflation, but so do insurance companies. So why is that? Well, with higher inflation, it generally means that the economy is going to be red hot. Then come rising interest rates as the Fed tries to cool down the economy before it overheats and potentially leads to hyperinflation. So by investing their float into high quality bonds, insurance companies will receive a higher yield on their investment as interest rates rise. This is because as interest rates rise, so do the yields on bonds, which makes for a much more profitable investing business model for the insurance companies. In addition, though, we also need to consider the economic health dividend. This simply means that improving consumer sentiment within a red-hot economy means that more people will be buying cars, houses, etc., leading to more premiums for insurers. Overall, this simply means that insurance companies will thrive during times of rising inflation and when the economy is doing very well, just like we're seeing today. So now that we understand a little bit about how insurance companies make their money, I do want to show you some of the tools to be able to help you choose a company on your own and be able to pick a great insurance company to buy. So I'll be sharing 5 key metrics to be able to help you value an insurance company and analyze it to figure out if it's a good investment or not. And as an example, I will be using Manulife Financial from over here in Canada with ticker symbol MFC.TO to be able to analyze some of these metrics. Alright, so first of all, the price to book ratio is a great metric you can use to figure out how expensive an insurance stock might be trading for. The price to book ratio is simply the share price divided by the book value per share, which is essentially just the shareholders' equity in the company. It's the value of the company if it were to be sold tomorrow and liquidated for its net asset value. So with a price to book ratio of 1 or lower, the stock may be considered undervalued, but of course this isn't the only metric that you have to look at because there could be other problems in the business model and it might be a value trap. Whereas if the price to book ratio is trading between 1 and 2, this could mean that it's fairly valued at the moment. And anything greater than a price to book ratio of 2 is pretty expensive for an insurance stock. For example, if we take a look at Manulife stock right now, the company is trading basically right at its book value, meaning that their price to book is equal to 1. To be honest, this stock is showing some pretty good value right now, especially considering that the PE ratio is super low and significantly below the 5-year average too. But I will be analyzing Manulife stock in a separate video if you guys are interested, so make sure to smash the like button if you do want me to analyze Manulife stock. Secondly, another very important metric to look at when it comes to the insurance business is the return on equity, or the ROE. So the ROE metric tells you how effective the management is at deploying the shareholders' capital within the business. It can be calculated by dividing the annual net income by the total shareholders' equity, or the book value. An ROE of around 10% is sufficient, meaning that it's going to cover the company's cost of capital and it will probably still give you a return on your investment. But an ROE of around 15% is ideal for a very well-run insurance business. For example, we can see from Yahoo Finance that Manulife has a return on equity of 13.3% in the trailing 12 months, which is pretty solid and definitely makes it worth looking into further. So while the price to book ratio and the return on equity are very common among many different stocks to use and analyze those companies, these next few metrics that I'm going to talk about are specifically for insurance companies. And so the third metric that we need to discuss today is called the loss ratio. This is the percentage of an insurer's premiums paid out as claims. As an example, if an insurer earns $50 million per year in premiums, but then has to pay out $40 million per year in claims, that would represent a loss ratio of 80%. So basically, as you can probably tell, the lower the loss ratio, the better, because the company is going to be retaining a lot more of that premium money, and then they can then invest that into high quality bonds or whatever investment they want. And of course, if the loss ratio is exceeding 100%, the company is not going to be making any profits and won't have any premiums to invest. Fourthly, another insurance-specific metric is called the expense ratio. This is the percentage of earned premiums that are paid out as business expenses such as salaries or office expenses, etc. So if an insurer has $10 million of expenses per year, but then they take in $50 million in premiums per year, this would represent a 20% expense ratio. And again, obviously the lower the better for this metric too, because that will help maintain the business's profitability. But of course, an insurance company can control their expenses a lot better than they can their losses, which would represent all of the claims that they pay out, because they have no idea when they're going to have to pay out those claims. Finally, the last metric I'm here to discuss today is the combined ratio. As you may have guessed, this metric is a combination of the last two metrics that I talked about, which are the loss ratio and the expense ratio. This metric helps to determine if the stock has an underwriting profit or loss within their insurance operations by measuring the incurred losses and expenses as a percentage of their earned premiums. So for example, if an insurer has $45 million of losses and expenses within a year, but then they also make $50 million in premiums, this would represent a combined ratio of 90%. And in this case, because the combined ratio is below 100%, this would represent an underwriting profit, and it is a sign of good risk management. However, if the combined ratio is greater than 100%, that means that the insurance business alone is not profitable and they're operating at an underwriting loss. So out of these last three metrics that I talked about, you really only need to understand what the combined ratio is, as long as you understand that it's built upon the loss ratio and the expense ratio, and you know what those two are. And by taking these 5 metrics into account whenever you analyze your next insurance stock, I can guarantee you you're definitely going to make some better decisions than going in blind. Overall, insurance stocks usually fall quite far under the radar, but they can be excellent recession-proof business models that can protect against inflation. Manulife Financial is one insurance stock that I'm most familiar with over here in Canada and that we analyzed in today's video. We can see that it is trading at some pretty good value right now and does have a good ROE, so this is a very good sign. But let me know if you want me to analyze this a little bit further in another video. It's also very important to remember that the analysis does not stop at these 5 metrics. You always have to do your due diligence and your research on the company so that you understand how it operates. And oftentimes this does involve doing a discounted cash flow analysis, which I have shown in several of my other videos. So definitely check those out if you're wanting to figure out what the potential growth returns could be. So anyways, I hope this video could shine some light on the elusive insurance business and actually help you to be able to analyze your next insurance company that you do want to purchase. But don't be afraid to leave a comment down below, because I do read them all and I'll try and get back to you with an answer. With that said, if you did enjoy this video, make sure to drop a like, as it does really help support my channel. And if you haven't already, definitely consider subscribing for more content just like this. And I will see you guys in the next one.